Sir John Redwood has warned the Bank of England not to correct its errors by tipping the UK into recession. The Bank of England should not try to correct its easy money mistakes by plunging Britain into recession, an MP has warned. The Office for National Statistics, ONS, revealed on Wednesday that Consumer Prices Index, CPI, inflation fell to 10.1% in March from 10.4% in February. Nevertheless, it remained higher than experts had predicted as food and drink prices continued to soar. Economists had forecast inflation would be 9.8% for the month. The high inflation level piles even more pressure on the Bank of England, BoE, over interest rates, with inflation still way above the 2% target rate. Conservative MP Sir John Redwood told Express.co.uk, the bank has lurched from easy money and buying up too many bonds at very high prices in 2021 to tight money and selling too many of the bonds at big losses. Sir John said inflation will come down this year, adding, the bank should act to smooth the cycle, not reinforce inflation on the way up and create a bigger downturn on the way down. They should not try to correct their inflationary mistakes in 2021 by imposing a recession in 2023. The Bank of England declined to comment. Julian Jessup, economics fellow at the Institute of Economic Affairs, said, today's grim inflation data have boxed the Bank of England into a corner. The Monetary Policy Committee has said that evidence of more persistent inflation would mean interest rates have to rise further, so another increase next month may now be inevitable. He added that a more credible central bank would be able to look forward rather than back and keep interest rates on hold. Mr. Jessup said, there are still many reasons why inflation is likely to fall sharply in the months ahead, including the substantial tightening in monetary and financial conditions which is only just starting to feed through, unfortunately, if you're only. Experts on Tuesday lined up to warn Bank Governor Andrew Bailey against a further interest rate rise. The current rate is 4.25%, Professor Emilios Avgoulias, International Banking Law and Finance Chair at the University of Edinburgh, told Express.co.uk, if they increase interest rates, a recession is on the cards. Households and businesses will not be able to repay their loans. This will bring unemployment and anemic growth and threaten the viability of British pension funds. Last month, the BoE said it believed Britain has passed peak inflation and today's figures help point towards this. The rate has eased back from a peak of 11.1% in October and is predicted to fall more sharply soon. The Office for Budget Responsibility has predicted inflation will fall to 2.9% by the end of 2023. It is hoped falling global commodity prices will start to bring down food price inflation soon, although supermarket bosses have signaled that inflation in the sector is not over. Households are also expected to first feel the benefit of falling energy prices in July, when a new energy price cap will be announced. The most recent projection from experts at Cornwall Insight states that the cap for a typical home could drop to £2,024.58 from July. Households are currently paying an average of £2,500 due to government support, Susanna Streeter, head of money and markets at Hargreaves Lansdown, said. The heat has been turned down on the bubbling cauldron of prices, but inflation is still scalding and interest rates look set to be pushed up again to try and cool it down rapidly. She added, the pound feels a lot smaller in our pockets right now as inflation continues to devour spending power, with wages rising so much more slowly, this insidious drain on wealth, and the worry that it's not temporary given that core inflation, stripping out volatile energy and food prices, remains so sticky means it's more likely another interest rate rise of 0.25.